What's up, everyone? Morning. Hello, YouTube. Hope everyone's doing okay here this morning. And today we have the day after the Fed, right? We saw the Federal Reserve dump out a 75 basis point hike yesterday, right? The biggest hike since 1994. And it was interesting, right? Yesterday we talked about this in the morning. I did warn about being one. What is this? I'm just inspecting this coffee. Something looks like. No, never mind. So the what I was saying yesterday was be very careful with this move, right? You're gonna get volatility, you're gonna get crazy movement, you're gonna get some insane stuff, and not trading this event or trading it very small really teaches you a lot about these events, right? Because just because it was a 75 basis point hike, just because there was a lot of hawkishness, doesn't mean that the market is just going to instantaneously dump. We saw that yesterday, right? We rallied, we dumped, we rallied, we dumped, right? And then right now we did print overnight new lows for the year. So it is very difficult to gauge these events no matter what you think the potential outcome of how the market interprets it. It's probably going to be something different, right? No matter what, it might be a lose-lose situation. So just keep that in mind. The only guarantee was that we weren't going to see an all-time high in yesterday, pretty much, right? So if you were selling calls that were at like 4,000, 4,500 on the S&P, you probably made some money, right? If you were selling some puts at like 3,300, 3,500, you probably made some money, right? The short side of the options yesterday is something that we played, and it is something that takes advantage of elevated IV, and it's even better when IV drops after the fact. So let's talk about this a little more. First, massive hike since 94, right? Biggest hike since 94. And another 75, 50 basis point move is expected in July. So again, I'm going to go to my trusty FedWatch FOMC futures here just to make sure, because yesterday was it was like 3% chance that there was a 100 basis point hike for yesterday's meeting. But we do have to keep in mind what's going on in July, because July 27th is the next meeting, and we can see every single meeting. So there is sorry, let me do some math here. What is the current Fed fund rate? It can't be this high. It's 150 to 175, I'm pretty sure. So it seems like there's the potential for what's going on here. Let me see what this is. It seems like there is it's pretty much 80% 100 basis point hike in July, which is going to be absolutely insane just based on FedWatch futures. Now a lot can change. Until then, we have over a month until that event happens, but they're pretty much expecting right now 100 basis point move, meaning that Jerome Powell yesterday showed his hawkish side, pretty hawkish, right? Things were well, let's see what he said. So he did start on the aggressive side, right? They sold off originally and then climbed and sold off overnight. What Powell said is he doesn't want to force a recession, right? It's not like the central bank wants to induce a recession. He doesn't want to see that people are out of work. He doesn't want people to be put out of work. He also said, of course, to never think too many people are working and fewer people need to have jobs. But we also think that you really cannot have the kind of labor market we want without price stability. So it's not going to be easy, and it may be dependent, of course, on events that are not under our control. So, of course, even the Fed pretty much said they don't know where the economy is headed. They're just projecting pretty much. They're projecting what may happen, how it can happen. And the idea is not to plunge things into a recession, but he also said that we're still going to do whatever it takes to get that price stability, right? To get that inflation under control. So if their expectation is now to have inflation under 5% by the end of the year instead of 4% like it was originally thought, then that means more aggressive hiking. There was a stat that I saw recently that when the Fed hiked aggressively, there wasn't a case where the Fed's funds rate did not exceed the CPI data and didn't form price stability. So what I mean by that is there was not an event where the Fed's funds rate was lower than prior month CPI that actually sought out for price stability, meaning that if we get 4% by the end of the year, there is going to be more aggressive hiking to get above that metric so that the Fed's funds rate is above the CPI data. That was confusing. So he also said, here's some remarks that I'm going to read from Powell from yesterday. He said the surge in price of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting price for gasoline and food and is creating additional upward inflation. He also said the consumer price index has been climbing rapidly since March 2021, which was a whole year before the Russian invasion. Powell himself also retired the word transitory last November, which was used several months before the onset of war and severe sanctions that followed. So this is the interesting part. Powell pretty much blamed everything except for what the Fed did leading up to this event, right? They increased the balance sheet by $5 trillion. They cut rates to zero. And apparently that is not at all the reason as to why this is happening. You can't have a $9 trillion balance sheet and expect inflation to be okay, right? This was an issue in 2001. This was not an issue in 2022 when the Russian invasion happened. So it seems like the blame game is continuously pressing on to steer attention away from the Fed. So I don't really agree with that, right? I don't think that's true. I think that a lot of all of this is caused by those artificially inflated price and an increased balance sheet and quantitative easing to the brim, right? We saw everything just explode. And right now, this softer landing is no longer anything in the realm of reality, right? It's going to take some insane engineering to kind of settle things down, which I don't think is going to happen. And there are still a lot of large banks that don't think that this will plunge into a recession. We're pretty much there, to be honest. We got 2 weeks until those, or 3-4 weeks until those GDP numbers come out for the prior quarter. They've already been predicted to be negative. So the thing is, the Fed said, in layman's terms here, they're going to keep aggressively hiking, right, until there's price stability. They increased the inflation targets for the end of the year, right? Because I think it was 4% prior. I'm not exactly sure what the exact number was, but they increased those inflation targets for the end of the year. They said that they're going to aggressively hike. They said that they don't want to plunge things into a recession, right? Their idea is not to cut jobs or decrease the amount of jobs in supply. But the reality of the situation is that it's going to be really, or sorry, here is the data. Here is the data. In 2020 or end of 2022, the Fed's funds rate, number one, is to be forecast at 3.4% versus the expected in March projection 1.9%. Huge difference, right? Double the amount there. And then inflation to be 5.2% instead of about 4% by the end of 2022 and about 2.6% by the end of 2023. So again, it's going to be interesting. Now, there are other things that I do want to talk about in terms of this potential recession that's going on, and to kind of talk about Powell's job speech here. We've also seen that over the last bit in terms of labor trends, even just this week, Coinbase, which obviously you can see that crypto is getting absolutely nuked, said it would lay off 18% of its staff, right? Redfin said that it would reduce 6% of its staff. Spotify said now that it's going to slow hiring by 25%. Other companies that are in the midst are Microsoft, Peloton, Carvana, obviously, PayPal, Tesla, right? And this is just the beginning. It's only about time until we start to see Apple, right, Google, and other even big banks start slowing hiring, at least without even cutting the labor force. But realistically, this larger drop in hiring, right, and also decrease in staffing is what tends to happen in late cycle transition into what we call a recession, or even early cycle, mid cycle of the recession. At this point, we start to see these layoffs really trickle in. So it's going to be difficult to navigate this from a quantitative tightening perspective. It's going to be difficult to navigate this from the Fed BSing about why this is happening, and also the labor front, right? So we'll see, right? Quantitative tightening just started this month. It's been 16 days of this month. So there's still a long way to go. There's still a long way for those aggressive hikes. There's still a long way until we actually start to see these labor number decreases, right? Because if they're just starting to begin over this quarter, right, it's going to be a lagging thing that we see in the coming months. So there's still a lot of potential downside realistically. Like I know that um, a lot of, well, not a lot, but most banks have a lower downside target. You can start weeding out the analyst from the better analysts at this point. But the downside target, right? I know a lot of people are looking for that 33, 3200 for looking at a temporary low, right? To see. I know some people have been talking about late 2000s, right? I know some people that are talking about 3500s. I think the target is around 3300 to downside because we're almost at 3500, number one. 34 to 36 is the first target. So we'll see what happens. Today, I don't know what the hell is going on with this market because I haven't looked at it in a while, but I think we are decreasing still a little here. I think like today I could see some more downside. We're starting to escape the balance to the bottom end. The balance was created around the low 30s on the S&P futures, right? We've now escaped that balance to the lower end, and we're going to be looking for some of that downside continuation. There's a pretty big balance between 3710s and 3657s, and in between that we have the 77s, the 93s, and then down at the 57s is the downside target. So we could see that explored this week. If we close in the 3600s, I think there could be a lot more downside. So I hope everyone has an amazing day, found this valuable, kind of talking crap about the Fed and the market's dead, Mr. Powell, but we'll see what happens here at this point. I think aggressive hikes are still on the menu. O'Keefe said, I remember being told that there would be a soft landing in 2008. Oh, geez. I don't remember that. I wasn't in the markets at that point, but look at what happened, right? 50% from the highs. We trimmed that pretty easily. I think like the bottom end of this move could be around like 40%, 45% from the highs. I don't know. We'll see. We'll navigate it as accordingly, but that's not good. And then how long did it oscillate like sideways until it actually caught a bid? So good morning, everyone. Just do the opposite of Kramer, pretty much. Yeah, I am Bulgarian, Mr. Georgiev. I can tell that you are too. So I hope everyone has an amazing day here. We'll see what we get. I am looking a little more leaning to the downside as long as we keep rejecting that 37, 33s on the S&P futures. I think there could be that slip into the distribution blocks to the downside, which starts to open up under about like 37.08, like 37, like 93. It starts to open up under those areas, and we're going to look for exploration to the downside. Above the 33s, right, there could be that potential where we get back in a distribution, kind of oscillate sideways, because we have Powell on Friday, I forgot to mention. So let's keep that in mind, and we'll chat soon. So let's jump into these rooms, and I hope everyone has a great trading day. So take care, and we'll see you soon. Bye.